Hello and welcome back. Still talking about Chapter 3, dealing with accrual basis of accounting. In this video, we're going to look at deferral adjustments as well as accrual adjustments. So remember, we said that when we're talking about the accrual basis of accounting, recognition is made regardless of when cash is either paid or received. Okay, so we're going to look at deferral adjustments. Remember, we have two deferral adjustments, right? We have our prepaid expense. We have our prepaid expense adjustment, and we have our unearned revenue adjustment. So the first example that we have has to deal with prepaid expenses. Okay, so let's assume for a minute that Mike's Bikes determined the end of year merchandise inventory to be $500. Okay, this represents that amount of the $3,000 purchase that has not been used up to generate December sales. Okay, so basically what we're saying is we started the month with, we'll say December, zero merchandise. Okay, beginning merchandise inventory was zero. Okay, throughout the month of December, we purchased merchandise inventory, right? The example of Giant Eagle buying pumpkins off of our farm. That's an example of merchandise purchases. So we're looking at a retail company that basically buys product from a wholesaler and then turns around and sells it to the general public. They sell it to us, right? So what we're saying here is that we're just looking at that merchandise inventory account. Throughout the month, we bought $3,000 worth of merchandise so we could sell it to the general public. At the end of the month, we do an inventory count and we find that we only have $500 of inventory left on our shelves. Okay, we need to determine what is the cost of the merchandise sold, right? Well, we started off with zero. We added $3,000 to that merchandise inventory account. At the end of the month, we have only $5,000 left. So that means that we had to have used or had to have sold $2,500 worth of merchandise. Okay, so this is an example of a prepaid expense. We bought our merchandise inventory, paid cash for it, right? Again, under the accrual basis of accounting, cash is inconsequential to when we recognize that expense. Where at the end of the month, we generated revenue, we need to match the expenses that we incurred to generate that revenue. So the adjusting entry we do is we debit cost of goods sold, which is an expense, and we credit merchandise inventory, which is an asset. Okay, this is just one example of a prepaid adjusting a prepaid expense. Okay, I don't care what prepaid expense adjustment you're doing, it doesn't matter. There is always going to be a debit to an expense and there's always going to be a credit to an asset. Okay, we're decreasing our asset to show that, hey, we've either used up this asset or this asset has expired over time, so we need to expense that. Okay, so there's a question in your workbook or study guide, whatever we want to call it. It says, per the video, what journal entry do we do for prepaids, right? Well, that's the answer. We're going to debit some sort of expense account and we're going to credit some sort of asset account. Okay, so let's look at another example of rent expense. Okay, or prepaid rent, right? Mike's Bikes prepaid 1 year of its $500 per month building rent. So at the beginning of the year, we gave our landlord a year's worth of rent, right? To book that journal entry, we're decreasing one asset, which is cash, because we're paying cash, and we're getting something for it. We're getting an asset. We're buying a resource that we can use in our operations. That's the prepaid rent, okay? At the end of the month, we need to make that adjustment, right? We need to match the expense with the revenue that we generated for that month. So what are we doing here? Well, again, we're going to debit an expense, credit an asset. We're debiting rent expense for $500 because we're increasing our expenses. Excuse me. And we're crediting an asset, prepaid rent, okay? And that goes back to the workbook or the study guide. Anytime you have to make an adjustment for a prepaid, what do? Debit an expense, credit an asset, right? Okay, so now we have depreciation, all right? Depreciation is a systematic expense, right? Think about back in chapter 2 when we bought equipment, right? Well, what were we doing? Well, and it's not on the slide here, but what we did was we said, okay, well, we're decreasing one asset, increasing another asset, right? We're going to debit equipment and we're going to credit cash. Nowhere at that point in time did we recognize any expense for that equipment, right? So we're now at the end of the month. We just learned about, or we are learning about accruals, but we already know what the matching principle or the expense recognition principle says that we need to match expenses with the revenue that we generated that month, okay? So what happens with depreciation, or what happens with the equipment? We need to expense that equipment. We need to recognize each month that that asset helped us generate some revenue, right? So we have depreciation expense. Depreciation expense is nothing more than a systematic recognition of expenses, okay, or a systematic decrease of an asset's value, okay? Depreciation has nothing to do with market value, okay? Depreciation is calculated based on estimates, right? So they tell us here that Mike's Bikes purchased equipment for $15,000, okay? The equipment is expected to have a useful life of 5 years. That means that Mike assumes or estimates that that equipment is going to last him 5 years, okay? Or he's going to get 5 years use from that machine before he buys another one, okay? They tell us that at the end of those 5 years, Mike assumes, again, this is not fact, this is all assumption, right? He assumes that at the end of those 5 years, that piece of equipment is going to be worthless, meaning he can't sell it to somebody else. Nobody's going to want to buy that machine that's used. It's worthless, okay? So they calculate monthly depreciation expense. They use straight line. Straight line says we take the cost of the asset and we divide it by its useful life, right? Well, 5 years, there's 12 months in a year. So we're basically going to get 60 months use out of this asset. So we need to calculate that depreciation. We need to systematically allocate the cost of that machine to each month that we're going to use it, okay? So we take the 15,000 divided by 60 months. We get $250. Each month, we're making revenue. We're using that machine to make revenue. We need to match the cost, or let me phrase that, we need to match the expense of that machine to the revenue that we generate each month. That's why we use depreciation, okay? What's the journal entry? Well, in order to recognize depreciation expense, we're going to debit expense, we're going to credit a new account. This new account is called accumulated depreciation. It is a contra asset account, okay? So we're going to debit depreciation expense for $250, credit accumulated depreciation equipment for $250. Now, this is very, very, very important, okay? Notice what we're doing here, right? This is an example of a prepaid expense, right? And I said, whenever you have a prepaid expense, you debit an expense, credit an asset, okay? That's true with the exception of depreciation. In order to book depreciation, we have to use a contra asset account called accumulated depreciation. Okay, why? Well, whenever we record assets, we record them at the cost, right? So way back whenever Mike bought that $15,000 piece of equipment, that's what Mike paid for it, 15 grand. It is always going to stay on our books at $15,000. We need to use a contra asset account, specifically accumulated depreciation, to determine our book value. Book value is the cost of the equipment, $15,000 minus accumulated depreciation. Okay, so very important that you know, memorize the fact that if we have depreciation, we're going to debit depreciation expense, credit accumulated depreciation. Okay, so the next adjusting entry we have is unearned revenue, or I'm sorry, the next deferral we have is unearned revenue, which is an adjusting entry. But remember, we're just focusing on deferrals right now. So remember, we said that under the accrual basis of accounting, if we receive cash before we earn it, we got to hit a liability account, right? We got to credit a liability account, unearned revenue. However, we are eventually going to earn that revenue, right? When we do that, we need to decrease the liability and show that revenue has been earned, okay? So whenever you have an unearned revenue or deferred revenue adjusting entry, what are you always going to do? You're always going to debit a liability and you're always going to credit revenue, okay? Specifically, you're always going to debit unearned revenue. You're always going to credit some revenue, whether it's rent revenue. In our example here, it's sales revenue, could be service revenue. It doesn't matter. It has to be a revenue account that we credit, okay? So let's look at the example here, right? On December 7th, somebody paid Mike $100 to fix a bike, okay? So on December 7th, we need to think, okay, what happened? Well, Mike got cash. And what did Mike give for that cash? Well, he didn't give anything, right? He has an obligation to provide someone with a service, which is fixing the bike, okay? So we're going to, on December 7th, we're going to debit cash. Our cash is going up $100, and our obligations or our liabilities are going up by $100 as well. Specifically, we're using unearned revenue, okay? A week later, somebody comes in and, a week later we provide the service, or a week later somebody comes to pick up the bike. What's the adjusting entry? Well, remember, we need to debit a liability, credit revenue. Specifically, whenever we hand over that bike or we complete that service, we're going to debit the liability, unearned revenue. We're going to credit cash. Okay, and we say, what's the explanation here? Oh, we're recording sales revenue from an advanced payment. Okay, now let's look at accruals. We only got two accruals, right? Accrued revenue, accrued expenses. So when we're looking at previously unrecorded expenses, that's what an accrued revenue is, right? Let's say, for example, that Mike's Bikes receives a $20,000 bank loan with annual interest of 6%. The first annual interest payment is due November 30th, 2017. Okay? So, we're December 31st. Those dates don't make sense, do they? Oh, yeah. Okay. So, yeah, they do. Okay, so on November 30th, we got our loan. December 31st, we got to close the books and show, did we incur any expenses? Do we owe anybody anything? Do we have any revenue that we earned but didn't get paid for, didn't record yet? Okay, so that's what we're doing. We're looking for our adjustments, and we say, okay, well, wait a minute here. We have unrecorded expense. We have an accrued expense here. What happened? Well, I owe 6% on a bank loan, right? I've had this loan for 1 month. I've incurred 1 month worth of interest expense. I'm going to have to pay it way down the road, right? Doesn't matter. I still need to recognize that I have an expense. I'm going to pay it, 11 months later, okay? So we recognize, so anytime we have any unrecorded expenses, we are always going to debit an expense and we're going to credit a liability, okay? So in this example, first thing we need to do is calculate, okay, what's the monthly interest expense? Well, it's $100, right? 20,000 times 6%. I need to recognize 1/12 of that. So that's how we got the $100. I'm going to debit interest expense for $100, credit interest payable for $100. Again, anytime we have an accrued expense, what's the journal entry we always do? We always debit an expense, credit some payable, okay? So let's look at an example of, actually, let's pump the brakes here. There's another example of an unrecorded expense that you will see, okay? You will see salaries and wages payable, right? Just like the previous example we gave in our last video. It's December 31st. We're in the middle of a pay period. We need to recognize that we incurred so many days of an expense, and we owe our employees so much. Even though that cash isn't going to happen till later, we need to stop now and recognize we have an expense, debit expense, we have a liability, so we're going to credit a payable. Okay, so let's look at previously unrecorded revenue, right? So let's assume for a moment that Mike's Bikes delivered an order for $200 for a $200 bike on January 31st, right? Customer is not going to pay for this bike until January 7th of next year. So when do we recognize revenue? Well, under the cash basis of accounting, guess what? We recognize revenue when we get the cash, so we will not recognize revenue until next year. We follow GAAP. GAAP says you got to do your adjusting entries. You got to follow accrual accounting. So under GAAP, with the revenue recognition principle, we recognize revenue when it's earned, right? Cash is inconsequential to that. When is recognized earned? Did we provide a service? Did we provide a product? Yep, sure did. Well, what about cash? Doesn't matter. Under accrual accounting, we recognize revenue when it is earned, okay? So what's the journal entry that we have to do? Anytime there's unearned revenue, you are always going to debit an asset, credit revenue, okay? Credit revenue, debit an asset. What asset do you specifically debit? Well, it's going to be accounts receivable, right? We have the right to receive payment. So we're going to debit accounts receivable for $200, credit revenue, right? When's the cash going to happen? January 7th. I don't care. We're doing accruals. We got to recognize revenue when it's earned. Okay. So what we have here is the adjusted trial balance in the form of a worksheet. Okay. To be honest with you, I'm not too concerned if you can't use a worksheet. The reason why is because worksheets are optional. You don't need to use them. You need to do your journal entry, so you need to know that. You need to know how to post your journal entries. You need to know that. You need to know how to create an adjusted trial balance. Again, how do we create the adjusted trial balance? Well, after we do our adjustments, we list all our accounts and what their updated balances are. That's it. We could use this worksheet to help facilitate that, okay? We can also do it just using journal entry and T accounts and create the trial balance. So if you'll notice, we have the unadjusted trial balance right here. And it's just a list of accounts and all the balances before we did our adjustments, okay? Then at the end of the year, we did our adjustment process, right? And we said, oh, okay, well, we had revenue, right? We had cost, right? Our revenue changed. It went down by $2,500. So we need to debit an expense, credit an asset. So we debited cost of goods sold expense for $2,500, credited our cash, right? We basically, those journal entries we just did, we're rewriting them in column form to get our adjusted balance or adjusted trial balance. So notice over here on the right, we have our adjusted trial balance. We show that our merchandise inventory account is updated. It's now valued at $500. It's not $3,000. We used $2,500 of it. Our adjusted balance is $500. Okay? And we just go through and do all the adjusting entries, right? Prepaid rent. Okay? Well, remember, what do we do when we have prepaid rent? How do we adjust it? Debit an expense, credit an asset. Specifically, since we're dealing with prepaid rent, I'm going to debit rent expense, credit prepaid rent, right? Then we go to our third example, right, which is another prepaid. It's depreciation expense. Okay, well, what do? I debit an expense, depreciation expense. I credit accumulated depreciation for $250. And we just go through and do all our journal entries, okay? The key thing is that after this process, debits and credits always have to equal, okay? And that's what this adjusting entry helps us do. It helps show us that we had unadjusted, we adjusted it, now we have the adjusted trial balance. And notice that debits and credits are always in balance, right? Even for the adjustments column, even for the adjusted trial balance column. Okay? So the following is not a type of accrual adjustment. Well, let's think about this. Let's start at the bottom. Unearned revenue. Yeah, unearned revenue is a deferral, right? Prepaid expense, number C, is a deferral, right? B, accrued expense is an accrual. Common stock. Common stock is not an adjusting entry, okay? We are missing one adjusting entry on this slide, and that's our accrued revenues, okay? So when we come back in our next video, I want to go ahead and kind of discuss a little more the adjusted trial balance and how we use that to prepare our financial statements. But please don't forget the important topics we covered here. We went through all the adjusting entries, right? We helped you fill out your workbook or study guide, knowing what you have to debit, what you have to credit for, unrecorded revenue, accrued revenue, accrued expenses, deferred revenue, prepaid expenses. So please make sure you memorize those. Definitely, put them on a note card. Utilize your study guide or utilize your workbook and use that as a study tool. When we come back, again, we're going to talk about the adjusted trial balance. We're going to see how we use that to prepare our financial statements. So thanks for tuning in.